Hello, fellow traders. 'Tis I, the Rumpled One, coming to you Wednesday, October the 28th. The year's 2020. Let's talk trading. The reality of trading. Cold hard truths. Part 3. I hope you tuned in for part 1 and 2. And if you have, then you know these videos for educational purposes only, and your results may differ from mine. Cold hard truths. I guess a couple of you kind of like this series. I guess I'll have to turn it into a playlist. Um, Another cold hard truth about trading is you really have to understand something. We've talked about, you know, things like luck and guessing, but when you're trading, you have to remember what's the most important thing, and that's making money. Okay. Now, some people say, well, you got to follow your plan, follow your method, do everything right. But the thing is, if you don't make money, you're going to be out of the game. You really are. And it's really tough because I was just talking to Walmall. He's kind of busy this week. That's why he's not on the phone right now, along with me. And I alluded to the skills that we have to have. And some people, put their comments out there and thank you. And you see, one of the skills is really understanding reality. And that's just a cold hard truth because people talk about chart reading and reading these indicators and fundamentals and a whole bunch of stuff. But you see, it all goes out the window when you put the trade on. And that's what most people don't seem to get. They don't understand that. They'll talk about all this other stuff, but once that trade's on, you are going to have emotions because you're human. You're going to have to manage those emotions because you're human. You're going to have to manage the money. You're going to have to manage the trade. So, we talk about managing the money and things of that nature. And so we always talk about risk management, making sure you don't lose more than you're willing to lose. So you put that stop loss on. Okay. So let's just say you're willing to lose $100 a trader. Let's keep it simple. You're going to play a dime a pip. You're going to lose a maximum $1 per trade. Okay. We'll just talk, dimes here. So you put that on. You enter the trade. Now, when you enter the trade, what's going to happen? As soon as you enter, you're going to be down by the spread or spread plus commission or commission. Okay. So you're already in the hole and you want out of the hole. And then if you go further in the hole, then maybe you start feeling mad, upset, yelling at the screen like I do. Or then, it starts to go your way. It's like you start cheering it on like a cheerleader. Come on, come on, come on. You see, you're getting caught up. You're getting caught up. Now, what you want to do is you want to overcome these things, the brain management. You know, you don't want to fear of losing out or missing out because if you looked at what I've done today, you would see some huge missing outs. And I could have Romo up the yin yang. I could have Rogo up the yin yang, and definitely regret of being stupid. Yeah, because I'll admit, I did put an airball trade on. It got me into some trouble. I traded my way out. Had I just left everything alone when I woke up, I would have had, because I had a short on, I would have had a nice profit. But, I didn't really feel too much pain because I've kind of overcome this stuff. Every now and then it's just like, dang it. Basically, if anything, I always have the regret of being stupid. It's like, why did I do that? Why did I do that? Why did I do that? That's my regret. But these other ones, not so much anymore. Um, And the reason I feel stupid is because I know better. That's the thing. And then on the other side, take profit before the market takes it back. I mean, like on the trade I'd averaged in, and on one of the um, pieces, I was up, I think, I don't know, about 4 or 5 pips, maybe six. And had I acted, I could have taken that piece out and another piece out and basically wiped out a losing position with a winning position. But I hesitated and wound up only taking a pip off of that winning position. But I did get in at about a 10 pip less position, and I traded my way out of the mess. But had I left things alone, I would have been up huge. So you got to have this money management down too, um, and that's all part of it, And the reality is, another cold hard truth is, as I mentioned, once you put the trade on, everything else, all your analysis, it goes out the window, and you have to kind of switch gears. And that's why I've said this, many times over the years. Is your entry screen and exit screen the same screen? Because maybe it shouldn't be. Maybe you enter on one screen, but you exit on a different screen because there's different things you might want to consider when you exit. And Mighty One chimed in on a comment, and he says, if you're in a position and you move your stop loss up and you're long and you don't buy, then you're not really that confident, or you're not really thinking it's going to go up. And it makes a lot of sense when you think about it. If you believe something's going to go up from where you're at, then you should buy. He says, if you're going to, why move your stop loss up and it only triggers your stop loss, and what? Maybe you give back 5 pips? Why not just exit now if you don't think it's going to go up? I mean, and that's a cold hard truth. I mean, why are you moving your stop loss up and at the same time you're not adding in? Something to ponder. Thanks for that one, Mighty One. I remember you told me that one, I don't know, a couple years ago or longer, maybe 5 years ago by now. Time seems to fly by. So, still have two pairs that haven't filled that weekly gap. You can see we're 54 pips off of the bottom right now. Um, Very interesting uh, turn of events here. You see, we broke out of the opening range of the week here, pushed down a lot. We got into the opening range of the month, and it just shot up, and then it just shot back down. You can't see it on the daily chart, but when we get to the other charts, you will be able to see it. 276 pips below the daily or the yearly open. You can see here we're back into the inside bar area of the inside bar from 6 weeks ago. There's some inside bar action happening here. For those of you new, if you see a gray number, that means it's prices in the inside bar. So this would be 2 months ago, 4 weeks ago, 29 days ago. If you see blue, a blue one, that means that's a current today inside bar. That's kind of like, so you have to look and see what's happening there. Lots of pairs over 100 today. Yesterday there was only one. And as you can see here, we had a huge spike. I think there might have been news or something this hour. But tell you the truth, I was long down here. I kicked myself, for not going long at 25, and I didn't go long at 50 because I was averaged in. And had I left things alone, I could and put a TP somewhere at 13 or $1.30. And I even told Walmart, I said, you know what, if it's going to go back to 130, it has to. And sure enough, it did. But I didn't put my TP there. I jumped out. And you can see here, we're in the rat zone. It was the weekly lower rat zone. And I'm going to talk about the rat zone in an upcoming video. A couple of things about it because some new people have been asking about it. Um, so I'm going to do some more detail because one thing about the rat zone, it can be above a wick zone, inside a wick zone, or below the wick zone, and might want to have some consideration there. You can see price hit the daily S2 on the pivot chart. It did take out the pivot. Um, for those of you new, FPP is the future pivot point. If the day were to close right now, this is where the pivot would be. And since we know the pivot usually gets taken out, you can plan your trades heading towards that number. And here we have the missed pivots. You can see we had 3 in September, none in October so far. And I added a screen here because Walmart asked me about this, so I thought I should share it with you. He wanted to know how often does price actually hit the pivot. So here, this is my price travel analyzer that I wrote back in 2017, and that's a donational. And so here, open less than the pivot point, out of the last 100 days, it was 54% of the time. And then the high was greater than the pivot point 45 or 83% of the time. So if, in other words, if you went from pivot to the open, you had an 83% chance if it was the pivot was open, if the open was below the pivot. Now on the downside, the open greater than the pivot happened 46 times out of the last 100 days. 46% of the time. The low was less than the pivot 31 times, or 67%. So you can see you've got 2 out of 3 or 4 out of 5 chance of hitting that trade. Now, some people say, oh, I don't have time to sit in front of my screen because I have to work. Well, this is a possible trade. You, at the start of the day, you see, okay, pivot's that direction. You put the trade on, you target the pivot, and you can see what happens. So for those of you, I can't sit in front of my screen. There's an opportunity for you. Wick zone, in and out, in and out. You see in and back out. I was on the phone with Walmart when this happened. I wasn't even looking at the chart. We were discussing other things at the time. But you can see here 147 pip range, 79 percentile. So the red rats were here, green rats, the smart rats were here. And we've got the simple price action template here. I did make an addition. Maybe you can see it or not. I put in the previous candles high and low. And the reason is sometimes it might be between the Walmart lines. So for example, right here, let's see, this was a close right here. So this would have been the short line. And this would have been the long line. That's not a good example. Where's a good example? I don't know if I see one today. Oh, here would be an example. You have the high here. You have the open. Well, instead of waiting for the 50, you take the trigger here at the high. So right here, you see you got a trigger here at 60 to go long, but then you got a second trigger. You might want to add on right there at 65. Just like here. In fact, Walmart called this trade out for me. He said, yeah, he'd go long at 56. And sure enough, it was good for almost 10 pips. And this is a perfect example of taking the pips before the market took them back. If you went long at 60, there's 50 pips you could have had. Maybe you weren't quick enough to pop it out at the top, but you should at least been able to get 40. No excuses, right? So, fellow traders, cold hard truths about trading. Hope you enjoyed it. And remember, if you're new here, subscribe, click like, and welcome aboard. And always remember and never forget, It's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.